It's time for the big picture. For that, let's welcome in the team from Charles Schwab. Michelle Gibley is Director of International Research at Charles Schwab, and Cooper Howard is Director and Fixed Income Strategist for the Schwab Center for Financial Research. Michelle, Cooper, great to see you both. Cooper, let's start with you. We've been talking a lot about the jobs report all day today, but also in this show. One thing that we haven't touched on yet is the move we saw following the report in Treasury yields. Break that down for us and what you make of it.
Yeah, so I think that there were two moves in Treasury yields today. So the first one was after the jobs report. What we saw is that it was probably a jobs report that the Fed could cheer. We saw the unemployment rate move up like we had mentioned earlier in the previous segment. That's not good news, but I think for the Fed hiking interest rate, it is good news. We also saw some easing wage pressure that also bodes well potentially for inflation. So on that, two-year treasuries really dropped pretty significantly on the expectation that the Fed's probably not going to have to hike as aggressively, or at least the rate hike in September is really off the table. Then the second move in treasuries, I would say, is probably after the ISM numbers came out. And they came out a little bit more better than expected. So it bodes well for this whole notion of a soft landing. And I think gives a little bit more credence to the idea that maybe the economy can continue to hum along without really catering. So I think that that's kind of the two big moves that we've seen so far today.
Cooper, I'm going to stick with you for just a second. Michelle, I promise I'll get to you. But good news for the Fed in that the September rate hike is off the table. But what about the rest of the year? Do you think the Fed's done, or are there more rate hikes to come?
You know, I think that there's a lot of data to come between now and then, but I would be surprised if they hike by the end of the year. Barring a surprise in inflation or kind of a turnaround in the labor market to where it shows further tightness or additional tightness, then I think that we're probably done in this cycle. But I think instead of a hike or a not hike, really the more important story that the market's watching is how long do we hold at these elevated levels? And the expectation is that the Fed is going to cut at some point, but that's likely not going to be until about Q1 of next year. So long as we continue to see kind of a good economy hum along, that shows that maybe they hold at a longer rate or a longer level than expected and maybe cut later into Q1 or possibly early Q2 of next year.
Okay. If we have time, we'll come back to that. But Michelle, I want to turn to you and broaden out the conversation to a more global reach. In terms of global central banks, what should we be watching for in the coming weeks? I saw Bank of Canada on the calendar for next week.
That's right. We're seeing more central banks starting to pause as those prior rate hikes are finally starting to bite. Next week, the Bank of Canada meets. They could pause after hiking the last two meetings, and Australia is expected to remain on pause. The game really heats up the week after next with the ECB, where markets earlier this week had a 50% probability of another hike, but now they're only having a 23% probability. And so these signs that prior rate hikes are biting were really evident in many reports this week, including an unexpected contraction in Canada's Q2 GDP, a surprisingly soft CPI figure in Australia, and CPI in the Eurozone pointing to further easing once the summer ends. The risk, of course, is that inflation reaccelerates. Today's global manufacturing PMI showed that both input and output prices rose for the second straight month.
And Michelle, we know in China they've really been trying to ramp up support to get the economy there back up and running, but you expect slower for longer growth in China. Tell us why.
Yeah, you know, we had a manufacturing PMIs in China come out yesterday night, and they unexpectedly increased in August, which may suggest a stabilization, but they do continue to roll out these piecemeal measures to support the economy, but it's likely to have difficulty accelerating to the past rates of growth. And the reason is that the property market is just really a big drag on growth. It contributes to 20% of GDP and represents 70% of household wealth, and household and homebuyer confidence is low, and they might need signs that property developers are in good financial shape before sales improve. So yes, we're saying get used to slower growth in China. China's slowdown is likely to be contained to China, although commodity exporters could feel a bigger impact.
And Cooper, bringing it back here to the U.S. and circling back to that potential rate cut in Q1, the Fed will need a reason to cut rates in Q1. And if the soft landing scenario is what's on the table, why would they be cutting rates? Because inflation's back to target, or is it because the economy could potentially fall into a recession?
I think that it would be clear signs that inflation is coming down to target. I don't think that they're going to start rate cuts once we hit that magic 2% number. But I think that Chairman Powell has come out and he said that we really have to be confident. And when I say we, the Fed has to be confident that inflation is moving towards their 2% target. They've been laser focused in this cycle to try to get inflation down. Now, I do believe that they probably will get inflation down to their target. It's just how much pain do they want to endure to try to get it to that number? So I think what we'd have to see is that clear signs that we probably could reach that 2% target. And then from there, they'll start to normalize rates. They're not going to hold them at these elevated levels for all the time, I would say. At some point, they're going to have to start to cut.
All right, we have to leave it there. Cooper Howard, Schwab Center for Financial Research, and Michelle Gibley, Charles Schwab. Thank you both so much for your insights. Have a great weekend.